They say bankers created the gold standard. But it was Isaac Newton, the scientist who discovered gravity, who first anchored trust to measurable gold. Newton entered politics through an unusual door. As Cambridge's elected member of Parliament, he possessed voting rights in the House of Commons, a privilege granted to Oxford and Cambridge universities. But it was his Cambridge contemporary, Charles Montague, Chancellor of the Exchequer and co-founder of the Bank of England, who transformed Newton from scientist into the machinery of state power. In 1696, Montague appointed Newton as Warden of the Royal Mint, promoting him to Master 3 years later. Newton now controlled Britain's monetary standards, the weight, purity, and definition of English money. This was no ceremonial post. The Mint answered to the Treasury, and Newton was frequently consulted on currency policy and national finance. He set the gold-silver ratio that governed international trade. When Queen Anne knighted him in 1705, it wasn't for the Principia, it was for rebuilding the nation's credit. Britain itself was transforming. The Glorious Revolution of 1688 had transferred fiscal control from monarch to parliament. War debts and colonial expansion demanded not just coins, but a system of credit. The question was, what would guarantee that system? Metal or credit? At the time, English silver coins were hand-hammered, with smooth edges easily shaved. Citizens discovered they could clip tiny silver shavings and still spend the coins at face value. This wasn't fraud. It was rational self-interest. The result was a cascade of distrust. Coins lost 20 to 30% of their weight. Merchants began refusing payment. International traders rejected English currency. Tax collection stalled. The pricing system was collapsing not from war or plague, but from millions of small acts of private optimization. The government hesitated. A full recall could bankrupt merchants, ignite unrest. The Bank of England proposed a safer remedy: keep both metals in circulation, expand paper notes to fill the gap, extend confidence without changing the rules. Newton insisted, if trust could be clipped and weighed, then it had to be rebuilt, not inflated. He launched the Great Recoinage of 1696, a total recall and reissue of England's silver. The mint ran day and night. Newton installed machine-struck coinage with milled edges and engraved lettering. He established chemical laboratories to verify purity. Every new coin would be a promise kept in metal. The operation succeeded. English currency regained its credibility. Trade resumed. But Newton had learned something troubling. The real enemy of sound money wasn't foreign powers. It was millions of hands, each scraping away a fraction of trust, turning private gain into national inflation. While Newton enforced silver's integrity, a deeper question emerged. Should England anchor its currency to gold, silver, or both? The Bank of England, founded in 1694 to finance war through public debt, opposed gold monometallism. Their reasoning was institutional. Gold reserves were insufficient for an expanding credit economy. A pure gold standard would freeze lending and strangle commerce. They advocated flexible bimetallism backed by paper currency, money as managed confidence rather than fixed measure. As silver prices fluctuated, Newton argued for gold as the natural unit of measure, stable, universal, scientifically determinable. In 1717, his gold price proclamation effectively established Britain's gold standard, fixing gold's value in silver. Here was the fundamental divide. Newton believed trust must be based on measurable metal content. The bank believed trust emerged from government credit and market confidence. Newton advocated fixed standards leading to stable trade. The bank advocated credit expansion, leading to economic liquidity. Newton saw the state's role as maintaining measurement standards. The bank saw it as managing psychological expectations. Newton won the policy battle, but the philosophical war between rational measure and managed belief remained unresolved, and it would come to a head in the greatest financial catastrophe of the age. In the summer of 1720, South Sea Company shares soared to £1,000 each, roughly the equivalent of £200,000 today. The South Sea Company, founded in 1711, was a masterpiece of financial engineering. It was designed to turn government debt into marketable stock, a way to enable continuous borrowing without raising taxes. Bondholders were invited to trade their government bonds for shares in the company. The state, in turn, transferred its obligation. Instead of paying interest directly to the people, it paid that interest to the company, which then used the money to pay dividends to its shareholders. On paper, it could have worked, if the trade had. The plan relied on profits from British trade with Spanish America, but by 1719, Spain closed its ports and seized ships, cutting off the company's only real source of revenue. With trade revenues gone, dividends depended first on government interest, and then, when that wasn't enough, on the money of new investors. In the summer of 1720, what began as a clever experiment in finance ended as a national collapse. Even the government and the Bank of England were drawn in, forced to finance the illusion they had helped create. It was the first time in history that a government's credit system collapsed. Not through war or famine, but through belief. Newton himself invested early and sold at profit. He had escaped. But in late 1719, he did something irrational. He re-entered the market, drawn not by calculation, but by the gravity of belief itself. In the end, Newton lost 20,000 pounds, roughly 20 million pounds today, half his fortune. As the bubble swelled toward collapse, Newton demanded an inquiry to expose how prices had been manipulated and to let the market correct itself. He believed the state's duty was to defend standards, not illusions. Bank Governor John Hanger, backed by Parliament, argued the opposite. Confidence, he warned, was fragile. Even a hint of doubt could ripple through the markets and bring down the entire financial system. The institution had to intervene to stop panic, even when the panic made sense, even if it meant fueling speculation. Newton's position was uncompromising. The market had detached from reality. Truth, he insisted, was the only foundation of credit. Prices must be allowed to find their natural level. At last, Parliament chose stability and credit, not truth. It was Montague who had given Newton power, and it was Montague who built the credit system that would take it away. Newton didn't resign after the crash. He remained master of the mint until his death in 1727, but the government stopped asking his opinion. The mint, once central to monetary policy, became a technical production facility. The Bank of England emerged as the de facto central bank, not through legislation, but through necessity. The institutional shift was complete. The mint's core logic was physical order, maintaining and enforcing standards. The bank's was psychological order, issuing currency, managing debt, rescuing markets. The mint became an execution agency. The bank became the central monetary institution. Newton's gold standard would shape the 19th century, but his defeat in the South Sea crisis established the template for modern central banking, the management of belief as a legitimate function of state power. Thanks for watching. This is the floating ledger, decoding the systems we still live under. The modern world wasn't born in a moment. It was engineered over centuries by capital, law, and design. From medieval credit to modern markets, Europe and North America wrote the operating code of power, and we're still running on it.